So before we jump into segment two, we wanted to provide a bit of an update. So apparently several drones tried to go after a U.S. stronghold in Syria. Those were shot down. Apparently a U.S. military vessel that was operating as you go into the Sea of Aden and then into the Red Sea. It appears that there was something launched from Yemen, which was also struck down by the anti-aircraft, anti-missile defense of the assets. And again, these are very important things to watch because this is going to drive some fear, some of that geopolitical risk. We've said that, crude is likely to, or I should say Brent is likely to stay between that 90-92 level, but we could get, snaps up just given something like this escalation, the fact that something was pushed into the U.S. region, or I should say within the field of view of the U.S. naval assets. But it's important to also consider that typically, so rockets, drones hit Iraqi base housing U.S. forces. So we've had another strike. This is going to be a very important piece because, again, when you look at some of the things that were shot down in the Red Sea and in Syria, sometimes some of those things will be let alone because they're not close enough. But because of the situation and how everything is on high alert, we're at a point where anything that comes within a striking distance will be struck down. Just a matter of, make sure that you're aware of some of the things that are happening, because this is also the risk that the Fed's going to have to try to, find its way through. And if you look at the 70s when we had the oil embargo, the Vietnam War, we had just quote unquote officially come off the gold standard. There are a certain amount of similarities that we have to attend to when we look at what comes next. Before we get started into that, we will also want to look at remote work. How remote work hit a post-pandemic low. Top and bottom, 5 work from home states. It shouldn't be surprising. It's in areas where you typically have to drive a great distance, or there's typically terrible amount of traffic. For those that have ever tried to drive around Boston, or anybody that's tried to drive around Baltimore and essentially Silver Springs into DC, you can attest to how terrible it is. And then it shouldn't be surprising that the work from home rate is lower in areas where traffic is typically minimal. There's a bit more open space like North Dakota, Alabama, Wyoming. As somebody who has driven through Wyoming, I would have no problem driving to the office because it's an enjoyable hour versus in New York where it could be a very terrible hour. So again, those are just some things to look at when you start looking at shifts in the way we're consuming crude, the way we're consuming diesel, gasoline, and how the U.S. consumer is going to shift. Now we want to get towards some of the things when we look at rates. So first, we're going to start with the 10-year. So you can see the 10-year is pushing towards that 5%. For those that have been following us back since 2020, our base case was that we were going to see the 10-year go over at least 4%. And then as it started to go through 3%, we had said, look, it's likely to go north of 4.5% and probably above 5%. And one of the things that we've said to people, and this is, because there's been a pushback of, it's going to stop innovation. Go back through history. If you think about the tech boom and all these different pieces, if you told someone in the mid 90s that the 10-year was at 5%, they'd be like, yeah, and like it was just normal because again, we've gotten used to this bond bull market, which if you draw a trend line starting in the 1980s, the trend line was straight down. So from 1980 to 2023, we were in a very tight trend line. And my whole comment, and again, we wrote an article about this in February of 21, that the bond bull market is over. And this is what we've been talking about, is you're starting to come back to what is going to be deemed as a more normal rate of return. And that's why we do think, the ZIRP or zero interest rate policy is at an end, especially when you start looking at the debt levels. Because remember, back when the 10-year was sitting at 8%, we had a deficit of, 3 trillion and, an economy that was growing. And now we have a debt level of 33 going on 34 trillion. And it's a very different world. And again, these are things that are going to weigh on what type of risk premium, what type of inflation premium are people going to put on this, which is why when you look at the 30-year, it's starting to break towards the highs. We do think the 30-year goes to 6%. One of the big things at this point in time was that our view is that you're going to get a flip in the yield curve, and we'll talk about this in a minute. But it's not going to be because the short duration is going to drop. It's more because the back end of that curve is going to go up, and we will get some of the short duration come down a bit. But again, the whole curve has now shifted up, which is going to put pressure on things, especially when you look at bank credit. Bank credit has moved negative. That's just because again a lot of banks haven't managed their risk properly. They haven't managed duration. You're starting to see kind of a slowdown in the risk people and banks are willing to take. And a lot of that is also because when you look at vacancy rates, what does their collateral look like? Do they have to take collateral write-downs? Do they have to have bad debt expense? And a lot of these write-downs, if you look at the most recent filings and earnings from banks, there was hundreds of billions have been written down. And a lot of that is because of the commercial real estate, the real estate sector, and just again, that mismanagement on rates were going to be low forever. The U.S. government bond curve, this is what we were saying, where the whole curve is moving up and to the right. But one of the comments that we've made is that 1 month to 1 year, you can see that the move was minimal. But instead, you've seen the rest of the curve kind of catch up to it. And that's going to be the piece to watch, because as inflation continues to reaccelerate, as the Fed talks more about raising rates, as our deficit continues to get worse, people are going to demand a higher and higher rate for the 30-year, 20-year, 10-year. We had a very soft auction in the 30-year, which spooked people. And again, that's why we're seeing that bond curve get pushed higher. And now the U.S. financial conditions are tightening once again. They're going to continue to tighten. And it actually, I would say, angered or annoyed the Fed that it actually softened, because the last thing they want is for this to soften. They want this to get tighter. They want to see that slowdown. So then when we start looking at the implied terminal rate, it's come down a bit, but starting to grind up once again. And the reason why is because, Powell came out and flatly said inflation is still too high. Retail sales are strong. We need to get in front of this. And realistically, he has not taken off the table. And his comments were rates can go up again. And one of the things that we've said is, for those that have been following us, we said that November was going to be a rate hike. We have since kind of kicked that to the right, because there is likely going to be a pause because of the geopolitical uncertainty. We do see Israel moving into Gaza starting this weekend. We thought it was going to be the previous weekend. That was delayed due to Biden showing up in Israel due to inclement weather. And at the same time, there's also a certain amount of surprise that they want to maintain and assets that they want to soften prior to entering. One of the things, and it's going to be important to look at how we see this operating. We do think it's going to be about a 6-month process. And one of the things that Israel should do if they want to stay in the good graces, and we'll talk about this on Friday, and we put it in the C6 commentary, which we'll put into the primary vision insights this week, is, India has made deals with the UAE, Saudi Arabia, and if you look at the corridor, Israel has maintained and has gotten better relations and normalized relations with Bahrain and the UAE. So realistically, Saudi, for obvious reasons, they have paused all of the normalization of relationships. But what Israel should do is go through Gaza, clear out some of the Hamas, the actors there, and then turn to the GCC and say, look, we will help provide military stability. We want you to come in and build up the government. We want you involved in, Sunni to Sunni type setup. We want you involved in managing this area. And that's going to be the olive branch that they can pass back to the GCC and try to then use that as leverage to re-engage, because we haven't seen UAE and Bahrain move away from their relationship. We don't think they will from an economic perspective, from a military perspective, from a US perspective, an India perspective. So it's just going to be a matter of how do you create this linchpin, and we have a good chart showing, what the trend was going to be and what it was prior to the Gaza, the Hamas attack into Israel. So again, these are going to be some key pieces to watch. And the reason why we talk about this so much is because as that shifts, that's going to, again, create some of that strife and struggle, but just keep the bigger picture in focus that we do see a certain amount of Iranian influence failing, a more push from the U.S. and others to get the GCC back involved, to get Egypt back involved, to maintain those relationships. But it's going to put pressure on things in the near term. Wage growth has slowed in the U.S. That's something that they want to continue to slow. But as you have this uncertainty in a very robust side of the world, when you look at energy flows, energy absorption, it's going to be, well, what does that do to inflation? What does that do to spending? And that's going to push things down lower. And as that fear rises, well, people are going to sell the international debt, sell the international currencies, move towards the U.S. And again, that's going to put more strife, more struggle on a lot of these entities when you look abroad. Now, when we pivot to interest costs, and again, this is looking at the U.S., interest costs are exploding. Again, like the way that we're spending like drunken sailors is only getting worse. And it's surprising, I know, that Powell came out and said fiscal spending isn't sustainable. Well, it's not sustainable, and it's going to take something extreme, and that's why we talk so much about Japan. Japan, the BOJ is trying to keep the yen below 150. They're trying to keep the 10-year below 1%. It's anytime they come in, the market pushes it right back because they smell blood in the water. And the biggest focal point is when you look at interest rates moving up, this has to be a wake-up point for the U.S. to stop its spending spree. Treasury liquidity declining as inflation and vol rises. Fixed income debt is volatility is increasing. Concerns at the Fed discount window. You're watching the discount window go up. That's something where, when you look at the RRP, it came down, but it's starting to bounce back up again. So the Fed discount window and bank term funding program still seeing incremental ticks higher, which again is a problem when you look at small, medium banks and the banking side. And that's where, as liquidity declines, it's because it's not that people don't want treasuries, it's they want the best price. So you're watching the when issued fall below where it actually issues because people are demanding higher and higher premiums, which is going to increase the U.S. interest expense over time. All the while, the Conference Board U.S. leading index, 10 indicators, continues to worsen. When you look at it, the leading indicators fell to 0.7% month on month. The estimate was for 0.4%. 18th consecutive drop on a year-over-year basis. The index fell 7.8%. And usually, again, at this level, we typically have a recession. Then when you look at the impact on unemployment from us, typically when you get that surge in the 10-year, borrowing costs go up and companies have to let go of workers. They can't continue to borrow to finance what they currently have. So again, unemployment percentages typically move higher, but the biggest issue that we've seen is that people still are not coming back to work. So you don't have the same level of employment activity, or I should say, people that are trying to get jobs, which is keeping that artificially lower and isn't going to be the same. Why is the Fed saying this about inflation? And here's a perfect example. Atlanta Fed sticky CPI accelerated to 5.1. The FRB Cleveland median CPI is 5.5. So everything in there is really keeping that core CPI and that sticky CPI moving higher, especially when you start looking at PPI, which we're going to talk more about in the next segment. And why that's going to be, again, that conundrum that the Fed has to attend to. They have to find ways to address this. And realistically, their easiest way to do it is to keep rates going up. Now, when you look at headline CPI, when you look at services, it was the biggest driver to it. Again, services is slowing, but the cost of it is still going up. It's still elevated. The 5 biggest contributors remains rent, shelter. It shouldn't be surprising to see gasoline in there as well. But rent and shelter is a bigger issue. And the fact that we've actually had home prices rent reaccelerate, it's going to keep that pressure overall. And as gasoline prices kind of normalize versus where they were, you're not going to get that deflationary benefit. Now you're starting to have an upward battle. When you look at the contribution of CPI, all the things that the Fed's trying to get in front of as PPI continues to stay higher. Core goods continues to be a problem at negative 0.4, but it's just when you look at core services, it gives you an idea of that reacceleration. That is not what they want to see, especially when you think about services making up over 70% of the U.S. economy. And for the most part, it makes up a large part of the economy in the developed world. Goods is more of an emerging market developing world, but they're trying to get bigger into the services as well. So again, this acceleration is going to be a pain point. Rent of primary residence is turning back higher. Owner's equivalent rent, again, turning back higher. They need to see this come down. And what we've said from the beginning, it was foolish for the Fed to buy mortgage-backed securities for so long. There was never a point in time that home prices or home buying was a concern. Maybe there was a 2-week period where people were like, oh, how's COVID going to impact this? And then when people turned around and said, I'm leaving the city and going into suburbia, they should have been like, all right, well, we don't have to touch this. But instead, they got too involved, over-involved, and here's what they have to now unwind. All the while, and I think this is important, and then we'll go through the numbers. After adjusting for inflation, U.S. retail sales fell 7.7% over last year, the 11th consecutive decline. That's the longest down streak since 2009. Nominal retail sales increased 3% versus a historical average of 4.7%. But it's important to put it into context because you also have a certain amount of seasonal adjustment. So the unadjusted retail sales fell 5.4% month on month versus the 0.7% increase in adjusted. So it takes time. We always want to look at both. So when you adjust it for inflation, they're not as strong. When you adjust it for how strong, buying was in 22, not as strong. But again, there's some strength in it as well, especially when you start looking at how GDP is calculated and how the Fed's going to look at it. This is more along the lines of showing that the consumer's not as strong as some of the top line data. And I think that's where we could see that drop off happening much faster, especially when you looked at the EIA comments that we had, when you looked at global trade and global trucking. So then when you look at U.S. retail sales, you can see that total retail, core retail saw some growth, adjusted for inflation, still remained elevated. Miscellaneous stores, non-store, motor vehicle, food services, gasoline, while we continue to have that drop on the goods front. But it's interesting when you start looking at, just how on a U.S. real retail sales, things remain fairly flat. It's obviously still going up. The control group's still going up. But remember, costs are higher. People still are trying to maintain their current level of activity, which I think is going to be a very problematic standpoint when you look at underlying flows in general. And then the other issue is going to be, is your student loan payments resuming in October? And how are you adjusting for that? Well, dining out is coming down, clothing is coming down, entertainment. Typically the things that are the most discretionary are going to fall the biggest. And we do see this continuing to move downwards. Now, how much does it take to be wealthy in America? For those that have seen the headlines where, people that are making $250,000 and still living paycheck to paycheck, this kind of gives you an idea of why. When you look at some of these areas, in order to be deemed financially comfortable in San Francisco, you have to be worth over, 1.7 million. Again, it's just the levels that they're not sustainable. And then when the U.S. is on course to build more apartments than ever, it's because there's that mismatch. Like there's people can no longer afford homes, so they're looking to, well, can I get a rental property? You know, can I get into an apartment? And that's where, just like in the 70s, you're starting to see that flip, which we do think accelerates. We'll talk more about that in segment 3. U.S. consumers are spending down excessive savings, you know, again, just exactly what we've been talking about. But foreign high-income economies are not. And this is that big deviation in terms of the U.S. drive to consume versus the higher income side. So I should say the foreign-born. And one of the things that we've been saying, and the comments have been made, is that the Gen Z is going to be, and the millennials are going to be scarred by inflation. And I think that's actually a good thing. Is you need to see an adjustment. And as somebody whose grandparents grew up during the Great Depression, it scarred them. I mean, they were babies, if not toddlers at the time, but it left such a drastic impression that it changed the way they became bigger savers. They didn't trust banks the same way. You know, I think you're going to see something similar, obviously different ways, but it will be a driving factor. U.S. Beige Book Activity Index continued to be fairly flattish, but, you know, at some point that, again, that consumer dries up, and that's where you get a much bigger slowdown. U.S. investors more optimistic about gaining from protectionism. You know, this is, I think, a bigger concern because there's a view that protectionism is a good thing, and realistically it's not. You know, whenever we've turned inward, you've had a growth in fighting, and you need someone bigger in a region, which again, you know, if you go back to Teddy Roosevelt, you walk softly but carry a big stick. You go to Truman and the Truman Doctrine, and then you look at Eisenhower, you look at Reagan, and some of the ways that they carried themselves on an international basis. It's, you have to be aggressive in the face of adversity, and if you try to turn inward and say, well, we'll let them figure it out, they can't, or they won't, because one of the things that we've highlighted is as socioeconomic fears increase, as economic stress increases, people split along tribal lines. And that's always been the case. It'll always be the case. You know, people are tribal at heart. And it's a matter of, you know, coming in and trying to help people diplomatically work through their issues. But unfortunately, with any bully, sometimes you need to punch them in the mouth. And I'm not saying that you have to kill them, but sometimes you have to, you know, make sure they're aware of your presence and make sure that you're aware of this won't be tolerated. And that's a point where, you know, typically if as somebody who's, you know, taking care of my sister who was bullied a lot from her illness, I was bullied as a child. It's, if you hit them once, you'll get a reputation, and then they won't do anything for a while. Then you might have to protect your reputation. And it's important to realize we can't just turn a blind eye to this and turn our back to it. That's not the way the world works. That's not the way humankind works. You know, if a bully takes an inch and you give them an inch, they're going to want a foot. Then if you give them a foot, they're going to want, you know, a mile. And if you give them a mile, they're going to want 10 miles. And at some point, you have to say enough is enough, because passivism and appeasement are just failed methods. U.S. investors see U.S. assets as more vulnerable to new tariffs. Again, that's a true, but it's also a certain amount of balancing act, and it's a matter of trying to create a level playing field against things that are currently available in the market. And these are those balancing acts. You don't want to over tariff, but you want to make sure that there's a certain amount of protection. And again, not looking at protectionism, because we're not saying that, you know, we're going to price you and tariff you out of existence. It's a matter of, well, are there dumping practices? Are there unfair economic advantages? And those are things that we have to be cognizant about. And it's not that it's bad or good. It's just a matter of, you know, being realistic and being open-minded about trying to address some of these inconsistencies. U.S. bankruptcy filings increased this year, which again, just showing more pressure points. Primary sectors, consumer discretionary, healthcare, industrials, you know, financials, which is obviously going to continue to get worse. So again, more pressure coming, especially when you look at the consumer side, because they're pulling back, and it's going to hit some of these key areas a bit harder. Number of consecutive days of the 10-year above the 3-month, just kind of showing back to where things are. Now, this is a new record for consecutive days of the spread between the 10-year and 3-month being inverted. When you look at New York Fed survey, household financial situation, much worse off than versus a year ago. That's something that we see continuing to hold firm. Adjusted retail sales, as we said before, came in at 0.7 versus estimate of 0.3. Control group came in at 0.6 versus 0.1. Retail sales trend reaccelerating, which again is a problem when you look at what the Fed's trying to do, yield curve where it is, dollar strength where it is, inflation reaccelerating, and again, spending going higher. Then when we turn around and we look at consumer expectations, saying it is much harder to obtain credit versus a year ago, somewhat harder. Again, all of these are good because, again, it pulls back leverage. It stops people from going out and trying to get a new loan. Small business optimism, again, starting to fade a bit, but still kind of holding in, and we don't see that changing too much in the near term, but over time it will get a bit worse. October New York Fed Service Index down sharply to negative 19.1, not back to January lows, but again, the steep decline. It's typically volatile, but this is what we've been talking about on services getting pushed a bit lower. No major improvement in CapEx plans, and it's unlikely to see that change given the pressure on borrowing and lending. October New York Fed Service Index down sharply, and it's the unfilled orders that is the bigger concern. Now, expected prices has come back down. As we've been saying, it's going to go sideways. You're going to get peaks and valleys, but the unfilled order side coming down speaks to, again, additional slowdowns, additional pressure that we see coming. Philadelphia Fed Business Outlook Index was expected at -7, came at -9. New orders rebounded into expansion, but again, work week slipped into contraction. Prices paid down marginally, but again, when you look at it overall, it's kind of a mixed number, and we still see this showing more contraction. And then when you look at the retail sales, less food, you get an idea that New York Fed slowed, Philly slowed. Retail sales had a bounce, but if you do it unadjusted, it was actually down a lot. So again, I think the retail sales side is a bit overstated, and it's going to be important to keep that in your mind's eye as we go forward and as we go into Q4 when people start buying for Christmas and the holidays, and how we do think that's going to disappoint a bit to the downside.